Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Again, I can't stress enough how important the slide 16 is. You can come back and listen to the archive and go through all that math yourself, and you can really see how important it is. Again, some years you're not going to see the effect, but this year, in a lot of European stocks, you're seeing it because the euro is down quite a bit. So here's the actual calculation, the formula. Rate of return equals the currency value at the end of the period divided by the currency value at the beginning of the period times the investment value at the end of the period, the local currency, plus any income you receive divided by the investment value at the end of the period in the local currency minus 1.00. So essentially what we're saying here is that you got to add or subtract any sort of gains in your currency, and then the interest rates are not free. So we might think, oh, well, you know, if I'm looking at the Australian dollar, I'm going to earn a better rate of return because I'm in Aussie dollars, and the overnight rate is better there. Well, it is, but there is a potential for, at least a greater potential for devaluation. So at least you need to consider that, and I'd urge you to jot this formula down, come back. I'll even send you the slides if you like. My email, I'll give that to you at the end. The local return is the result for local investors, not including currency fluctuations. A simple way to express currency exposure is the nominal investment returns less, that should be any currency returns, less any currency returns equals real investment returns, excuse me. Assuming that an investor might want to repatriate the money back to their local region, currencies do matter. The currencies cut both ways. During the credit crisis, the dollar strengthened. And again, the dollar has been strengthening, I guess, ever since December or November of 2009 against most currencies. U.S. investors that had international investments had currency drags on their investments. Non-U.S. investors that had U.S. investments had currency tailwinds on their investments, though. During 2009, the reverse was true. And again, we sort of switched back. So we went from 2008, where the dollar was strong, 2009 dollar weak, although December, I guess, we started a new trend. And if we would have known that at the time, well, we could have traded the ISE FX options very profitably. Of course, it's easier said than done to know that the trend was sort of ending there in November around Thanksgiving, at least the U.S. Thanksgiving, that the trend was shifting. Capital flows affect currencies. So investment, savings, speculation, and trade. What's the purpose of the currencies? Well, this is just a review to facilitate trade between countries. If importers or exporters have an imbalance of a currency relative to another, the spot currency market can be used to regain their desired level of equilibrium. Different markets trade currency. So we have spot market, which is the cash market. You have the futures market, which you're going to need a separate account. And then you have the options market, so you can trade right at the ISE, which allows you to either hedge or to implement a certain view. And you just need to have an equity options brokerage account. I'd urge you, and I'm sure many of you have already done this, to bookmark the FX options site. I really think it's a great place to go. Everything we have there is free. We're going to add some more tools in the next couple of weeks, so stay tuned. That's what if you have any sort of ideas, send them to me, and we'll look into them. Maybe we'll try to implement, roll these ideas out. Options are, just a review, bilateral contracts, which means it's either you're swapping rights and obligations, essentially, to buy or sell a particular asset. at a specific price and date. So the buyers are going to pay premium. They have limited risk. Sellers receive premium. They have substantial risk. They're cleared by the Options Clearing Corp. You need an equity options brokerage account, and these trades are done at the ISE. One thing that's great, at least I think it's great, we now trade these options. It's pretty neat. We trade the options at 7:30 in the morning. So for those of you that are looking at the currency markets, today was probably a great day to be trading these early because risk appetite started out and then it became risk aversion day. And if you had that view, that extra couple hours, maybe you would have gotten a little bit better price if you're trying to get long the dollar, as far as in most of the currencies or short the other currency, whether it's a call or a put. How are the options determined? Well, they're based on 5 factors: the currency pair value, the strike price, the time left until expiration, the interest rate differential, and volatility. Volatility is huge, of course. They're cash settled, which means they can only be exercised at expiration. That does not mean that you have to wait around until expiration. You can always close them out any day that the market's open. And they're cash settled, which means that, let's say on expiration day, that you decide not to sell it, but you would receive that settlement value. So if you were long the 100 call and it settles at 101, you're going to receive the difference between 101 and 100, or $1 times 100, or $100. That's just an example of that. Currencies and the impact of inflation, deflation. Local bond markets price risk and reward each day, and currencies react to the potential changes. So if countries do not retrench quickly, they will create a market fear of monetization that becomes self-fulfilling. Monetary policy may ultimately become impotent to control inflation. That's a quote from the Bank for International Settlements. That's April 2010. And again, we saw the Chinese moving a little bit to strengthen their currency because they're concerned about some of the other currencies. And there are some opinions about gold, how some nations are buying gold and sort of avoiding all currencies. Remember, please remember this, that currencies trade on a relative basis. So you just want to look at, we trade at the ISE right now, all dollar products. We don't trade cross pairs. We have the dollar either in the numerator or the denominator, so you have to have a view of the dollar and something else. So if you're bearish on the dollar, you're going to look for the strongest currency in your view. And if you're bullish on the dollar, you're going to look for the strongest, you're going to look for the weakest currency against the U.S. dollar. And that's how you might set up your options strategies. Risk appetite versus risk aversion, or the return on my money versus the return of my money. Currency markets ebb and flow each day, and we saw a great example of that today. And today was really a wild day. Looked like one thing was going to happen, and then, of course, later in the day, we saw a risk aversion coming back. There's lots of different ways that you can look at the spot prices. I took a screenshot of Bloomberg, and all we do at the ISE is we multiply the spot rates by a certain modifier to come up with these ISE pair values. So let me go through this. So you can do that. You can go to Bloomberg and look at the benchmark currency rates. Those are the cash rates. And let me just go through an example of one.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.